Good afternoon. Thank you for joining us for Rethinking Commodities Indexes, a one-hour webinar sponsored by Alps Distributors, Inc. My name is Dave Nadig, and I'll be your host for today's webinar. For those of you who don't know me, I am the Director of Research at indexuniverse.com, as well as the Journal of Indexes and the Exchange Traded Funds Report, the longest-running ETF-focused newsletter in the world. Today's webinar covers one of the trickiest topics in indexing, and that's commodities. There are a lot of new products and a lot of new approaches coming to the market right now, so it's topical. And it can be a bit tough to sort out the winners from the lemons. The format for today's webinar is simple. I'll start off by briefly touching on some of the history and background behind modern commodities indexes and modern commodity index investing. I'll also spend a fair amount of time talking about some of the very real problems that the current models have, digging into the structural flaws, some of the incorrect assumptions that are made in these sort of standard indexes. And then we'll go over some of the ways that indexers have tried to circumvent these challenges, to overcome these flaws. And we'll review some promising new approaches that are just starting to come to the market. To help us drive towards these real-world solutions, I'm going to need some help. So after I make a short 20-minute presentation where I sort of outline some of the key issues and problems, I'll bring in my panelists, both of whom have a few slides of their own to spark our conversation. First, I'm lucky enough today to be joined by Professor Geert Roenhorst of Yale University. Professor Roenhorst is the author of several of the key academic studies on commodities investing, and his recent work on commodities indexing is directly relevant to our conversation today. Second, I'll be joined by Sach Chadha, who's the Managing Director at Jefferies Asset Management and Head of Investor Solutions there. Sach has been doing a lot of work recently on the idea of tracking the commodities markets through equity investments. And you can read a recent paper on that topic in the May issue of the Journal of Indexes over at indexuniverse.com. A few housekeeping items before we get started. As a participant in the webinar, you can submit questions to me or to the panelists at any time during the presentation by entering them into the Q&A window on your screen. We'll collate the questions and answer as many as we can during the Q&A period at the end. Second, a replay of this presentation and a copy of the slides will be available at Index Universe within a few days. And for those of you who are viewing this live on May 6th, information on how to apply for continuing education credits will be contained in a follow-up email. With that, let's get started. So let's just start at the beginning. How did we get here? Why are we even talking about commodities indexing? Well, commodities themselves have been used as hedges for quite some time. The widespread use of indexes as a mean of seeking profit or speculation is a relatively recent phenomenon. It's a very recent phenomenon. It really traces back to a 2005 paper published by Gary Gorton and Geert Roenhorst, who's with us today, called Facts and Fantasies About Commodities Futures, often called the Yale Study. In the paper, Gorton and Roenhorst imagined an equally weighted index tracking the monthly returns of 36 different front-month commodity futures. And over a period of 1959 to 2004, their theoretical index saw a return of a little over 11%, and the S&P, on the other hand, returned only 10.5%. And that's what led to the quote that's on the screen, that in addition to offering high returns, the historical risk of investment commodity futures is relatively low. And that's kind of magic words for a large institution. And that would have been enough on its own. But the study also pointed out that their hypothetical commodities index actually demonstrated negative correlations to both stocks and bonds, while showing a positive correlation to inflation. So this seemed like secret sauce for a lot of investors. That paper and its follow-ups kicked off what has been the modern commodity index investing boom, which has really lasted to this day. This chart shows the Goldman Sachs Commodities Index in the blue line, and that's probably the most watched commodities index. It's probably the closest equivalent to the Dow or the S&P in the commodity space. And that index was actually started in 1991, but effectively nobody invested in it until the middle of the decade. That's when assets actually managed against this index really picked up. And it's important to note that Gorton and Roenhorst really looked at a pretty narrow type of index, very broad-based, but completely passive and long only. And so when investors started to pour their money into this space, And when issuers began to launch products tied to these types of indexes, they tended to follow that same model, which had the academic justification behind it. And today there are dozens of different indexes, but really 4 major ones that continue to dominate the space.